In 2012, the average person earned £27,000, paying an average of 23% income tax and national insurance combined, whereas Starbucks earned over 400 million and paid 0%.
It's an absolute hypocrisy.
The government is at fault here.
In this video, I'm going to show you exactly how they do it.
How do they do it? With perfectly legal loopholes.
Pay your tax! Pay your tax!
Clearly are not aggressively looking to avoid tax. They're looking to avoid tax on any structure anywhere.
So the first strategy that we're going to discuss today is royalty payments, otherwise known as profit shifting via intellectual property. I first want to set the scene by saying that Starbucks has headquarters in jurisdictions all across the world. Them jurisdictions are strategically low tax havens. I'm going to explain a working example of how they use royalty payments to reduce taxes drastically. And this is where the master tax planning starts. This first cut represents Starbucks UK. And what Starbucks UK wants to do is transfer the majority of profits over to Starbucks Switzerland. Because, you guessed it, it has the lowest tax rate. And it does that by using a chain of companies. One of them being in the Netherlands, which it's negotiated a special tax rate with the Dutch authorities, of course. And it does that by charging the 6% royalty. The 6% royalty being for IP. So use of the brand, the logo, the recipes, the business model. However, the Dutch company in the Netherlands only maintains an 8 to 12% margin to satisfy the Dutch authorities. And because the tax rate's higher in the Netherlands, wants to transfer the money over to Switzerland, which it does by a series of different charges and strategies, thereby reducing the taxable profit in the Dutch company to almost near zero. Now, this cut right here, which has got Starbucks profits in from the UK, pays close to 2% in taxes, thereby saving the UK entity 6.25 million in taxes. And that is the explanation of our first strategy. Let's discuss the next. And the second major strategy that Starbucks used to reduce its overall tax exposure is by using transfer pricing, specifically focused around the purchase of its coffee beans, which are strategically manufactured in Switzerland. Now, this is important because international commodity trading on coffee is taxed as low as 5% in Switzerland. So what happens is, rather than Starbucks going out and purchasing coffee beans off the open market, it purchases them directly from the Switzerland entity. And even more so, it has a middle partner that then roasts the beans. So in the Switzerland entity, there's an initial 25% markup on the purchase of the raw beans. Then when it gets to the Dutch entity, it adds a further markup for the roasting of the beans. By the time it then gets to the Starbucks UK entity, there's a near 25% markup, adding an extra 24 million on the cost of goods sold bill for Starbucks UK, resulting in a £6 million corporation tax saving for the Starbucks UK entity. Next on the list is leveraging debt, which essentially means Starbucks needs to fund operations, so Starbucks takes a loan from the parent company or other affiliate companies, again in low tax jurisdictions, and then charges interest on that loan. And we all know that interest is tax deductible in UK limited companies. And what Starbucks do is charge the London interbank rate plus 4% to maximise the interest payments as much as possible, thereby maximising the expense that can be deducted in a limited company. And Starbucks will use the same strategies to charge from the Dutch entities or the other affiliate companies and end up routing back to Switzerland, where, as you'll start understanding by now, pays the lowest corporation tax rate, thereby reducing overall tax exposure for the Starbucks group. It's worth noting that the London interbank official rate, plus 4%, is considerably higher than what McDonald's or KFC, who use similar strategies, use. So Starbucks have a lot of controversy in the news surrounding the strategies that they imply.
This is a system specifically designed to avoid tax.
Using an interest payment of £2 million, which was reported back in 2012, at today's corporation tax rates, that would be a saving of £500,000 in corporation tax.
So now we've discussed the three key strategies that Starbucks uses to reduce its overall global tax exposure. That is profit shifting via intellectual property on royalty payments, leveraging debt and charging from the parent companies, as well as transfer pricing. Now, as you've gone across these three different strategies, you've slowly started to allocate profits over to the Switzerland entity. Now, you're probably thinking by this point, there's still a large and reasonable amount of profits in the UK entity. Surely that's where it pays its tax. However, now the operating expenses get deducted out of the UK entity, resulting in not just a break-even point, so no tax payable, but actually resulting in a loss, which means that Starbucks actually paid zero tax, specifically relating to 2012, and actually generated a loss that it can then carry forward and then reduce the corporation tax payable on next year. Not a bad result, considering that for the average UK individual earning £27,000, you actually paid more tax than Starbucks when they earned over 400 million in turnover. This is an extremely common strategy for any large multinational or conglomerate company. Do you think this is ethical? Should they be allowed to do this? And if so, what can the government do to stop it? Let me know in the comments and let me know which large multinational you'd like me to cover next.